Bitcoin touched $60,000 this week, down 50% from its all-time high of $126,000 in October. And people are panicking. People are asking, is crypto dead? Should I sell? But here is what almost nobody is talking about. Because while Bitcoin's price is falling in dollars, the US national debt continues to grow at an unprecedented pace. So today, we're going to look at something different. Not will Bitcoin go up, but rather what happens to Bitcoin's value if the US dollar keeps doing what it's been doing for the last 100 years, and that is inflating. All while Bitcoin's very design, what it's programmed to do, is the opposite, deflate. I'm not here to hype you. I'm here to show you what some of the smartest investors on the planet are saying, backed by data. So let's get into it. Let me first give you the numbers, then we'll connect the dots. Because as of 2 days ago, February the 4th of this year, 2026, the US national debt is $38.56 trillion. That's according to the Treasury Department's official department to the penny dataset. The Joint Economic Committee reported in January of this year, so just a month ago, that debt had risen to $2.25 trillion over the prior year, which is about $8.03 billion per day at that pace. Now here's Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds. In July of last year, 2025, he said this on the Master Investor podcast, and I'm quoting directly. He said, if you were optimizing your portfolio for the best return to risk ratio, you would have about 15% of your money in gold or Bitcoin. 15%, not 1%, not 2%, 15%. Now that's a massive change from what he recommended just 3 years earlier in January 2022, which shows us that even the smartest investors on the planet are still learning about Bitcoin, which tells us how early we really are. What changed, you might ask? Well, he explains it clearly. He calls it a debt doom loop. And according to Dalio, Treasury supply pressure is driven by roughly $9 trillion of debt rolling over, which means maturing bonds that need to be refinanced, plus roughly $2 trillion of new borrowing tied to deficits, while interest costs near $1 trillion per year add to the strain on the system. And here's the kicker. He's not alone in seeing this or saying this. So let's look at what other major investors are actually predicting for Bitcoin's value by the year 2030. We hear from Cathie Wood, ARK Invest, as they just released their Big Ideas 2026 report this year, just 1 month ago, which is their 10th annual flagship research report. And here's their latest Bitcoin forecast. ARK projects that Bitcoin's market cap or capitalization will reach 16 trillion by 2030. Based on Bitcoin's fixed supply of 21 million coins. That implies a price of approximately $762,000 per Bitcoin. From today's price of around $67,000, now about 70 at the time of this recording, that's approximately an 11-fold increase, slightly plus, about 1,000% over the next 4 years. And ARK's latest forecast emphasizes a central projection based on what they call Bitcoin's maturation as an institutional asset class. Here's what's driving their numbers. According to the Big Ideas 2026 report, it goes as follows. For institutional adoption, they say US spot Bitcoin ETFs and public companies now hold about 12% of total Bitcoin supply. Regarding the digital gold narrative, they say after gold's market cap surged 64.5% last year, 2025, ARK increased their digital gold addressable market by 37%. And in terms of supply squeeze, they say, in 2025 alone, Bitcoin ETF balances grew by 19.7% and public company holdings increased by 73%. And corporate treasuries led by Strategy, formerly, of course, MicroStrategy, which now holds 713,502 Bitcoin. The report states that Bitcoin is, I quote, maturing as the leader of a new institutional asset class and is positioned primarily as a digital store of value, essentially digital gold. And Robert Kiyosaki, famously known as the author of Rich Dad, Poor Dad, made an even bolder claim in April last year. He said, and I quote, I firmly believe by the year 2035 that one Bitcoin will exceed over $1 million and that gold will be $30,000 and silver $3,000 a coin. His reasoning? Rising credit card debt, growing national debt, increased unemployment, weakened retirement savings, and inflation eating away at the dollar. But now let's talk about why these predictions exist. Because it's not just about Bitcoin going up, it's about what's happening to the dollar. Ray Dalio has been particularly vocal about this. He doesn't just say buy Bitcoin and get rich. He's describing a structural problem with fiat currency. On the Master Investor podcast, he said this, the issue is the devaluation of money. We are at the point of no return. So he's warning that the Western countries, not just the US, but the UK and others, are all facing the same debt doom loop. They're trapped in a cycle where they have massive debt, so they need to issue more debt just to pay interest on the existing debt. And actually, the Fed may eventually need to monetize the debt, basically print money to buy their own bonds, which makes the dollar devalue even more, and in turn, making investors flee to hard assets like gold and Bitcoin. Mind you, this is coming from an investor, as reputable as he may be, an investor who still prefers gold and has his reservations or questions he still needs to do more research on to answer and rebuttal his concerns. But as of now, his main concern is that governments can see who's doing what transactions on the Bitcoin blockchain, which is by design. And he has a question about whether the code could be broken or things can be done to make it less effective, including government controls. Which, of course, we know that quantum computing is a real risk to Bitcoin. This is a separate topic for a separate video. I'm happy to do a deep dive on for you. But essentially, Bitcoin could also become quantum computing resistant, something that I have a lot of faith and believe that the Bitcoin community will work on, the Bitcoin dev community will work on and fix. But either way, it's not a concern for many reasons until about the year 2040. But once again, let me know if this is a topic you want me to cover in depth for you. I'm happy to do that. And then, of course, if you understand the way Bitcoin was designed, programmed by nature, you would know that Bitcoin is immutable, meaning it's not alterable, and therefore countries can't control it. It's a proof of work network where nodes spread all across the world have to confirm each block's validity before it gets documented into the blockchain, immutably once again. Anyway, despite those concerns, he is still recommending a 15% allocation, even with the risks he sees in Bitcoin that frankly, I think he would not be worried about if he just did some more research. And here's where it gets even more interesting. Let's compare what's programmed into Bitcoin versus what's happening with the dollar. Let us first review Bitcoin's supply. Its total supply is 21 million coins, hard capped by protocol consensus rules. It was programmed this way. And of those 21 million, 19.9 million Bitcoin have already been mined, with its current inflation rate at 0.84% per year. That basically references all the Bitcoin that still need to come into circulation. And the next halving is in April of 2028, at which point the amount of Bitcoin entering into circulation will be cut in half. Bitcoin will be mined around the year 2040. But now let us review the dollar supply. What's the situation there? Well, we know that the dollar has an unlimited supply. That's the problem with it. The Federal Reserve can create new dollars at will, and the national debt is currently $38.56 trillion as of February 4th this year, 2026. With its annual deficit, approximately $1.7 to $2 trillion per year. Interest payments alone are over $1 trillion per year. And there's no mechanism to stop this, to stop the expansion. So here's the mathematical reality. If Bitcoin's issuance rate keeps stepping down over time, while the dollar supply keeps expanding, what happens to the exchange rate between them? This is what ARK Invest and blockchain analyst firm Glassnode call vaulted supply. a measure of coins that have remained dormant in wallets. And their analysis suggests a large share of Bitcoin's supply is effectively vaulted, often summarized around 40%, which tightens the available supply for trading. That means the effective float is even smaller than the raw numbers suggest. Meanwhile, according to Dalio's analysis, the dollar's supply has to keep expanding just to keep the system functioning. And Ray Dalio made a comparison that I think is very important to take into account. He said this crisis reminds him of the 1930s and the 1970s, a period when fiat currencies weakened significantly relative to hard assets. In 1933, during the Great Depression, the U.S. suspended domestic gold convertibility. The Gold Reserve Act of 1934 raised the official gold price from $20.67 to $35 per ounce, effectively devaluing the dollar by approximately 41% against gold. And in the 1970s, inflation hit double digits. Gold went from $35 per ounce to over $800 per ounce by 1980, which is a 22x increase. So Dalio's point is that we have seen this pattern before. When debt gets unsustainable and governments start printing money to manage it, as we're seeing right now, hard assets rally. And the main difference? Well, Bitcoin exists now. It's a hardness asset that's more portable than gold, more divisible, more verifiable. You can't actually verify gold bars. And it has a fixed supply that can't be changed by any government. Now, if we lean in to what Cathie Wood has to say, ARK Invest's model heavily weights institutional adoption, not retail investors buying Bitcoin on Coinbase. I'm talking about pension funds, sovereign wealth funds, insurance companies. And here's what's already happening according to ARK's Big Ideas 2026 report. It says that when spot Bitcoin ETFs launched in January of 2024, they saw about $4.6 billion in trading volume on their first day, an unusually large debut for a new ETF category. And as of last year, 2025, US Bitcoin spot ETFs and public companies hold approximately 12% of the total Bitcoin supply. And in 2025 alone, Bitcoin ETFs grew 19.7% from 1.12 million Bitcoin to 1.29 million Bitcoin. And public company holdings surged 73% from 598,000 Bitcoin to 1.09 million Bitcoin. And Strategy now holds 713,502 Bitcoin, approximately 3.4% of the total Bitcoin supply. But here's the key insight from ARK. This isn't speculative buying. This is institutional infrastructure being built. As more Bitcoin gets locked up in ETFs, and corporate treasuries, the available supply for trading shrinks. Economics 101. When demand stays constant, but the supply decreases, well, what happens? Price goes up. ARK's projection of Bitcoin reaching a $16 trillion market cap by 2030 assumes this institutional adoption continues at its current pace, which I believe for many reasons may, though no one knows the future exactly, even though they have been selling lately. Because once they see Bitcoin pumping again, as it will, they're going to jump back on the same bandwagon and they're going to actually help the wave pump all the more. That's my own personal interpretation and prediction for what's to come. There's actually an interesting twist to ARK's latest forecast that's also worth understanding, because in previous years, ARK heavily weighted Bitcoin adoption in emerging markets as a major driver of value. Their thesis at the time was simple. If you live in Argentina, Turkey, Venezuela, Lebanon, essentially countries where inflation runs 50 to 100%, even 1,000% per year, Bitcoin becomes a lifeboat for preserving wealth. But in their Big Ideas report, the one I'm referencing right now, ARK sharply reduced this assumption. Now, why? Because of stablecoins. In 2025, stablecoins, which are digital dollars pegged to the US dollar, exploded in adoption. And ARK Invest's Big Idea report of this year, 2026, estimates approximately $15.6 trillion in stablecoin on-chain transfer volume in 2024. So depending on your methodology, whether you use raw on-chain data or adjust for bot trading and DeFi activity, Comparisons to Visa and MasterCard's payment volumes can vary significantly. Some sources report figures as high as 27.6 trillion when including all on-chain activity. So for people in emerging markets, it turns out they don't need Bitcoin to escape their local currency. They just need access to digital dollars, which also stresses the importance of the Stablecoin Act being passed, which we know is still in the works, which I will cover as soon as we have any form of resolution, because we know that stablecoins are pegged to the US dollar. And because they're available internationally, they're actually a really good use case and method in which to keep the US dollar relevant, worldwide. But there is a caveat which may warrant a full deep dive into stablecoins, because stablecoins we know can also be printed or minted at will. So what does that say about their inflationary effect, right? Anyway, a separate topic for a separate day. Let me know if you want me to do a deep dive on stablecoins as well. But the point is, stablecoins are easier to understand and they're less volatile than Bitcoin. And they serve the payment function better than Bitcoin too. So that's why ARK adjusted their model. They reduced the emerging market contribution and increased their digital gold assumption instead. And this is actually more bullish for Bitcoin long term because it solidifies Bitcoin's role as a store of value and not a payment system. So it doesn't directly compete with the US dollar, which I wish more congressmen and women would understand. So Bitcoin doesn't need to be Visa, it just needs to be gold. And there are billions of people living in economies with unstable currencies who still need a non-correlated hard asset to preserve wealth over time that they can literally pick up and leave with if they need to. You can't do that with gold. So let's bring this all back to reality. What does all of this actually mean for you and for me? First, we need to understand what Bitcoin is. It's not a get-rich-quick scheme. The people making these predictions, Dalio, Cathie Wood, institutional analysts, they're not talking about Bitcoin as a lottery ticket. They're talking about it as a hedge against monetary debasement, which is happening in real time. So the thesis is simple. If governments keep printing money, as they are, and we can't see that ending, and if that causes currency devaluation, as it historically has and continues to do, and if Bitcoin's supply remains fixed, which it's programmed to do, and if institutional adoption continues, as it continues to do as well, then Bitcoin's value relative to dollars should increase significantly over time. Now, notice all the ifs that I just said. This isn't guaranteed, but it's a framework based on historical patterns, code, supply and demand dynamics, and current trends. Secondly, even if the bulls aren't saying put everything in Bitcoin, Ray Dalio, who's highly skeptical and still learning about Bitcoin, frankly, says to put in at least 15%. He didn't say 50 nor even 100%, but he said 15%. And thirdly, it's important to note that everything that I mentioned, okay, all the experts I quoted, they're all giving their predictions into the future. They're not saying it's going to happen next month. They're saying by the year 2030, by the year 2035, meaning there's still a ways to go. So this is a long-term thesis. And fourth, and this part is critical, these predictions assume Bitcoin survives. They assume no catastrophic failure, no quantum computing disrupting the network, and no government bans that would actually work. Because essentially the only way governments could disrupt Bitcoin is if all the countries of the world, give me your thoughts on this, agreed at the same time to ban Bitcoin mining facilities. If they could all crack down on it at the same time, then perhaps the network could be in jeopardy. But even then, we have people like Elon Musk that would just take mining to outer space, you know? Anyway, here's what we do know for certain. The US national debt is $38.56 trillion as of February 4th, just a couple days ago, and it's growing by $8.03 billion per day. And Ray Dalio, one of the most successful investors alive, who's still a bit of a skeptic, he's not all in 100%, recommends at least 15% allocation to Bitcoin or gold, which is up 1 to 2% from just 3 years ago. And keep in mind, once again, that you can't actually verify that a gold bar is 100% gold. That can also be a separate topic if you'd want me to do a deep dive on how I know that. I'm happy to do a whole video on verifying gold and digital gold for that matter. But carrying on, Kathy Wood's ARK Invest projects Bitcoin at approximately $762,000 by the year 2030 in their Big Ideas 2026 report. And we know that Bitcoin's supply inflation rate, which will continue to get cut down and down. And we know that Bitcoin's supply inflation rate is 0.84% per year. And the new issuance, block subsidy, halves approximately every 4 years, with the next halving coming up in 2028, at which point Bitcoin's inflationary rate of how much new Bitcoin's entering the system will be cut again in half. All while the dollar supply is expanding, on the contrary, by billions of dollars per year with no mechanism to stop it. It's like a train flying down a hill with no brakes. It's going to crash. That's why there's such a sense of urgency in the government to pass this whole stablecoin law clarity act. And that's why Trump's administration has created the Bitcoin Reserve, because they know that the US dollar is doomed unless they do something and implement a way to offset it and offset their debt. And all of this is happening as US spot Bitcoin ETFs and public companies now hold 12% of the total Bitcoin supply, up from 8.7% just a year ago. So the question isn't, will Bitcoin definitely go to $762,000 or $1 million? The question is, what happens to the relative value between a currency that can't stop expanding and inflating, like the US dollar, and an asset that can't expand beyond 12 million units, Bitcoin? History suggests that when fiat currencies debase, hard assets rally. So Bitcoin will have its day here soon. Gold did it in the 1970s, going from $35 per ounce to over $800 an ounce. And Bitcoin is positioned to be digital gold for the 21st century. Whether it actually plays out that way, well, we'll find out over the next 5 to 10 years. But one thing is clear: the smartest money in the world is paying attention, and they're not scared. They're not buying Bitcoin because they think it's going to make them rich overnight. They're buying it because they think the alternative, worst case scenario, staying 100% in fiat currency, like the US dollar, might make them poor over time. So perhaps it's time we shift our mentality. So that's the thesis: no hype, no data. Historical patterns, and what the people who manage trillions of dollars are actually saying. So if you found this video valuable, my arguments valuable, let me know in the comments. Let me know if you have any questions about it. And let me know if you want me to dig deeper into any part of today's video, whether it's the technical details of Bitcoin's supply schedule, the specifics of ARK's model, or Dahlia's debt cycle analysis. Let me know. I'd be so happy to do a deep dive on any part of today's video you have questions on. That's it for today's video. That's it for this week of content. I hope you enjoyed, and I will be back here on Monday. I love you guys so much. I'll see you guys in the next one.